Hey everyone, welcome back to Corporate Decoder, where we break down the inner workings of big companies just for you. And trust me, Bioventus has got some surprising moves in their latest filing. They're going to make you say, wow. So we're diving into Bioventus Inc.'s quarterly report, and get this, they just ended their quarter on June 28, 2025 with some really interesting financial shifts. Let's jump right into the numbers because they tell a story. For the 3 months that ended in June of this year, Bioventus brought in about $47.7 million. Now, that's a slight dip from the same time last year when they had over $151 million. It's not a huge drop, just a little over 2% less. But when we look at the longest 6-month period, the trend continues with sales down from about $280 million to $2071 million. It's not a huge drop, just a little over 2% less. But when we look at the longer 6-month period, the trend continues with sales down from about $180 million to $2071 million. It's like they're selling a tiny bit less each quarter. Now, where are they saving money? Well, look at this. Their selling, general and administrative expenses dropped a massive 18% for the 3-month period. And for the first half of the year, they shaved off almost 13% from these costs. This seems to be a big part of their strategy to manage expenses. Research and development also saw a cut, about 25% for the quarter and nearly 10% for the half. It seems like they're tightening the belt across the board, which can be good for profits, but might mean fewer new ideas in the future. This careful cost management is actually turning things around, operationally speaking. They went from a significant loss in the prior year's quarter to a profit of over $18 million this year. And for the first 6 months, they also turned a loss into a profit of nearly $7 million. That's a huge swing. And that positive operational shift is reflected in the bottom line. They actually made money this quarter, over $7 million for the Bioventus shareholders, compared to a loss of over $25 million last year. It's a dramatic improvement. Let's quickly peek at the balance sheet. Their accounts receivable, basically money owed to them by customers, went up slightly to around $132 million. That's normal. And their inventory also increased a bit to over $96 million. So they're holding a bit more stock, which can be good if sales pick up, but risky if they don't. On the debt side, the short-term portion of their long-term debt is around $43 million. It seems like they're managing their immediate loan payments okay, and their long-term debt not due in the next year is sitting at almost $298 million. This is a significant chunk of money they owe. Now, for the good news on the equity side, their total stockholders' equity is now over $2,025 million at the end of last year. This means the company is starting to build more value for its owners. Let's talk about cash flow. The money they generated from just running the business operating activities was about $6.6 million for the first 6 months of the year. This is less than the almost $9.2 million they had last year. So while the company made a profit, they're not bringing in quite as much operating cash. And financing activities, which includes borrowing and paying back money, really took a hit this year. They used almost $14 million in financing activities compared to about $12 million last year. This shows they are actively managing debt and likely paying down some significant loans. In fact, they made a huge move on July 31st of this year, refinancing their debt. They took out a new $300 million loan and replaced their old one. This new loan is a bit cheaper in terms of interest, potentially saving them about $2 million a year. It also pushes back their debt deadlines further into the future, which is always a good thing for stability. Now, let's talk about what's not in the report but is important later down the line. They successfully got FDA approval for new products called Talisman and Stimpril. These are for treating chronic pain using nerve stimulation. They're planning a limited release in the US this summer with a bigger launch in early 2026. This really signals their focus on growth in the pain management sector. Okay, legal stuff. Remember that big shareholder lawsuit we talked about? The one that accused them of unfair practices and issues with their financial reporting. Well, it seems like that's settled. They paid out about $15.3 million to wrap things up. This is a big deal because it removes a cloud of uncertainty that was hanging over the company and was costing them a lot in legal fees, as you can see from the significant drop in shareholder litigation costs this quarter. Looking at the business segments, the US operations are seeing a slight decline in sales, about a 4% drop for the quarter and almost 4% for the half. This is mainly because they sold off a part of their business called the Advanced Rehabilitation business. International sales, however, are showing some life with a small increase in the quarter and almost a % increase overall for the first half. This is good to see, especially with global economic uncertainties. And the gross profit, which is what's left after you pay for making the products, is mostly flat overall. But the profit margins in the US actually improved slightly. This might be because the sold off business wasn't very profitable. Their selling and administrative costs going down so much is a major factor in their improved profitability. It seems like they've really honed in on cutting costs here. Now, for a quick look at their adjusted EBITDA, which is a way to see how profitable the core business is without some of the one-off costs for the quarter, it's down slightly to about 33.4 million last year. And for the 6 months, it's also down from about $57 million to $53 million. So while they're making an operating profit and cutting costs, the actual cash generating power of their ongoing business might be slightly weaker. This is something to watch. The drop in operating cash flow is a bit of a concern, even though they are profitable on paper. It means that while they are selling products and cutting expenses, they might be seeing slower payments from customers or increased investments in inventory or other assets. Overall, Bioventus seems to be in a better place financially than last year. They've managed to cut costs effectively and are now profitable. The refinancing of their debt is a smart move too, giving them more breathing room. However, the slight dip in sales and operating cash flow suggests they need to really push their newer products and international markets to get back to strong growth. The new nerve stimulation products could be a real game changer if they catch on. Alright, that's our deep dive into Bioventus's latest financial report. What are your thoughts on their cost-cutting strategies and their new debt deal? Let me know in the comments below. If you found this breakdown helpful, smash that like button and subscribe for more corporate insights. And hey, join our Discord community linked in the description for even more discussions. Thanks for watching. See you next time.